Hey, folks, happy Friday. Thanks for tuning in to our MMG weekly recap. So, rough week, obviously, for us in mortgage and housing. Interest rates ticking up to peaks we haven't seen since May of 2019. So, it's been quite some time, nearly 3 years. And why? Well, it all started with Fed Chair Powell and a couple of other Fed presidents coming out and speaking very hawkishly, aggressively about the pace of rate hikes. I think Fed Chair Powell said, there's a need to move expeditiously to a more neutral rate. And again, a neutral rate is a rate that neither helps or hurts the economy. The current forecast is for that rate to be about 2.4%. That means about 8 rate hikes from here. But then here we are on a Friday, we got hit with a slew of bank and investment firm calls for much more aggressive rate hikes. Citigroup talking about 4 consecutive 50 basis point rate hikes starting in May. And what I have up on the screen is right now it's about a 75% chance that the Fed does raise rates by 50 basis points. So that's starting to get baked in for May, as well as the following meetings. And so those calls for higher rates are there. Ironically, Bank of America came out, also called for multiple 50 basis point rate hikes, but in the same breath said they expect the 10-year note to peak at 2.5%, which is ironically what it hit today on a Friday. So we're dealing with just this hawkish tone and the inflation fears, which are real, and then of course the idea that the Fed's going to stomp it out with rate hikes. On the other side of the equation, we are already seeing a tightening of financial conditions and consumer sentiment sitting at literally recessionary levels. So it's one thing to talk about doing all these rate hikes; it's another one to actually do it. And so next week we get some data, a jobs report, as well as the Fed's favorite gauge of inflation, PCE. And what we're going to be tuning into and what you should be watching is that month over month number. If that month over month number comes in a little cooler, that could remove some of this hawkish tone from the Fed. And the opposite is true. If it comes in real hot, that's going to ramp up and give new life to this. The idea that the Fed can go ahead and hike a bunch of times. Now, what we said going into 2022 and what we're still living through is if the Fed is able to hike rates a few times and the economy can absorb it, then we should expect long-term rates to tick up. In 2018, that happened. They hiked rates 3 times and rates ticked up, long-term rates. Then they did it just a 4th time, and the bond market said, can't do it. We're already starting to see yield curves invert, where the 5 and the 7-year note are now higher than the 10-year note. 30-year, 20-year paper is yielding more than 10-year paper. So the yield curve is already a mess, and it's starting to tell us something, and that is, maybe that things are slowing down, and it will be very difficult for the Fed to hike rates that many times and stomp out demand. Anyway, we'll see. Next week we have, again, some big numbers, jobs report and PCE. Those are going to be important to watch. Hope this finds you well. Thanks for tuning in. Have a great weekend. Talk to you soon. Bye for now.